Okay, great. Let's take it away. So it's a pleasure to be with you all here. Thank you for joining. My name is Nadav Ellinson. I'm a financial planner and a financial educator here in Israel, co-founder with Aaron, who's with us on the call as well from Blue and White Finance. And Aryeh, do you want to introduce yourself?
Sure. I'm Aryeh. I'm an Israeli accountant with a US license to prepare tax returns, and we've built SimpleTax to help Americans living here in Israel file their taxes in the best
Obviously, their
possible way.
YouTube seminar is a way for you to get to know them so that you can pay them
And
for
I'll
their
just
financial
mute,
consulting
if everyone can mute
services.
themselves, then that will be helpful. I'm going to mute participants and then Aria, make sure I guess you unmute yourself. Okay, good. Excellent. So RSUs is obviously a very important topic for those of you that have them. They can be worth a lot of money, and the tax is complicated. And today we really want to focus on the practicalities. How do we manage our RSUs? When do we want to keep them? When do we want to sell them? And how does tax come into play in that discussion? And so today we're going to have a mixture of having a look at financial planning and risk management for RSUs, taking a look at the US tax issues for those here that are US citizens. And for those that aren't, you can sit back a bit and just enjoy the fact that you don't have to worry about those complexities. And then we'll have a look at some of the Israeli tax issues and Israeli tax strategies. And between Aria and myself, we'll talk about the interplay between them and how that should affect the way that you can manage your RSUs. So I think Aria wanted to say something just to begin, and then I will dive in.
Right. So I think that when we come to look at RSUs, it's a not the simplest of matters to start with, but then when we talk about the interplay specifically between Israel and the US, it becomes that more complicated. And just to give you a taste of the complexities, so let's try to think about it. If you have RSUs that are with a trustee or without a trustee under 102, and then if you held them for less than 12 months, over 12 months, but less than 24 months, over 24 months, each one of those is a different scenario. And what happened if you sold them immediately when they vested, or you held them for that year and sold or laid them that year, or you sold them in the following year? That's three completely different scenarios. And I could go on for hours here. There are literally dozens of different scenarios. Each and every one of them has a different tax treatment from both a US and an Israeli tax perspective. And when you try to make the interplay between them work, it becomes mission impossible. And that's why I believe having this planning and having a webinar on this matter is so important.
Okay, excellent. So hopefully a good portion of you might understand some of the concepts that Arya mentioned. And for those that don't, we're going to try to break them down. We'll spend just a few minutes in the beginning breaking down some of the basic concepts, and I'll walk you through them. And then we'll dive into the topics that I mentioned. Now, if you have questions, try to note them down for yourselves. If you want, you can ask them in the chat, but we're going to address them at the end. We'll be presenting for about 40 minutes between the two of us, and then we'll leave about 20 minutes at the end for any questions that you might have. So just want to point out from the outset that I myself am not a licensed tax advisor or investment advisor, and we're speaking in general terms educationally, and it's worth speaking to a professional about your own personal situation, or perhaps using SimpleTax for the American side of things, which we'll get to as well. Okay, so let's start from the very beginning, right? You've got RSUs. RSUs are essentially shares that the company has given you. And whenever clients come to me for financial planning, one of the biggest questions is like, how much are these RSUs actually worth? There's a number that appears in my trustees portal in IBI or in ESOP or wherever they're held. But I don't know if that's the amount that's going to appear in my bank account at the end of the day. So if we have a look, firstly, at just the basic concepts, right? We have three stages when it comes to an RSU. There's the grant stage where essentially you sign the contract and you receive the RSUs themselves. There's vesting, which is essentially when the RSUs become yours and you kind of hold shares in the company. And then there's the stage where you come to sell them. And so when we're thinking about like what RSUs do we actually hold and how much can we take into account within our own personal financial plan, The thing that we care most about is the vest stage, because once they're vested, then they're yours, and you can decide whether you're going to go ahead and sell them. And so the first stage in calculating what they're worth is you simply look at the number of shares, the number of RSUs that have vested, have a look at the current stock price of the shares of the company that you work for. And when you multiply one by the other, then you get a total number, in this case, 250 shares, $200 each. And so you hold $50,000 worth. And that's the before tax figure. And so that's the first input in this calculation. The second stage.
Nadav, sorry, maybe Nadav, if you could go back to that one for a second,
Yep.
maybe just to add on to what Nadav said. When we talk about grant investing, we're talking about RSU to start with. I think one of the important things we need to understand are RSU is short for restricted stock, for stock units, which means you're not actually a shareholder. That's one of the key points in understanding the different timings that would be relevant over here, because when you have these RSUs, you're merely a potential owner of these shares in the future. And basically the vesting means we're taking these shares and we're taking these units and churning them into actual shares. What that means is that a day before the vest, you're not a shareholder, you're not entitled to dividends for example, and whereas a day later, you are all of a sudden also eligible for dividends if your company distributes such. So that's another thing that Nadav's going to be talking about throughout as well, that we're actually transforming from one type of vehicle to another during the cycle of what an RSU is. And I think that when people understand that underlying essence of this vehicle, it makes a material impact.
Cool, very important. Excellent. So the second side of things, which is obviously the one that most people struggle with a bit, is like, what are they worth after tax? That's what we care about. Like, if you want to use your RSUs to do something, to buy a house, to buy a car, then you need to know how much you'll actually receive in the bank at the end of the day. And we're each going to go into the US and Israeli tax aspects, but just a few principles, because really you can get to a pretty good estimate just with a back of the napkin calculation. So in most cases, we pay quite a bit of tax in Israel, and it gives us enough tax credits when you do it in the right way to cancel out the tax that you would otherwise pay in the US. And Aryeh is going to go more in depth into that. And the tax that you'd pay here in Israel usually ranges between 35 to like 50, 53%, depending on lots of different factors, which I'll go into on the Israeli side at the end after we have a look at the American. But it means essentially that back of the napkin calculation, right? We had an example where your RSUs are worth $50,000 before tax. It means that after tax, you'll receive about $25,000 worth after they're sold. Now, there is a case where even back of the napkin, you can assume that you'll receive a little bit more. And that's where the stock price has gone up quite a bit from the day that they were granted to you until the day that you end up selling them. Because in that case, again, we'll go into the tax reasons for this as we proceed. But in that case, your overall tax is going to be a little bit lower. It'll be closer to like 35 to 40% rather than at 50%, because you've got kind of these gains within the growth of the stock price. And so if you're just looking at your account and you see what the value of your vested RSUs are there, take off 50%, and that will get you roughly to what you'll end up with in the bank at the end of the day, at least in a conservative sense for most people. So that's in terms of the RSUs, what they're worth, and how they can maybe fit into the financial plan. But then the most important question is, where in the financial plan do they fit? Because often RSUs, because they're complex and because they're not really like in your bank account, people often think about them as something a little bit disconnected, as extra money that's nice to have, but I'm willing to gamble with. What I'd like you to do from a financial planning perspective is change your view on that, especially if you have a significant amount. I've seen clients that have 80, 90%, sometimes more of their whole net worth in their employee stock, in RSUs, in stock options that have become public. And when you're holding them simply in just one company, there's potentially a lot of risk there. We'll talk about risk a little bit more in a moment. But what I want you to do is to start thinking about and think practically for yourselves now, like what eventually do I want to use my RSUs for? Are the RSUs crucial to my monthly spending? I've got clients where their net that they get from their salary isn't necessarily enough to cover their spending, and they rely on regular sales of RSUs to be able to fund that. If so, then we're thinking about RSUs in one certain way, and it's very short term, and we have to be able to manage the risk there. Are we planning to use RSUs to buy a car in a year and a half? In which case, it's also very short term. Anything less than 2 years, you can see here the light blue bucket is very short term. And being in the stock market at all, let alone being in one company, has a lot of risk involved there. Or on the other hand, maybe these RSUs are extra. You're saving them for the long term. You really anticipate that the money that comes from them is going to help you in retirement, is going to go to an inheritance maybe one day, or be used to help your children in 20 years. In which case, they fall into the long-term bucket. And when we think about risk, I'm going to show you some examples and then hand over to Aryeh. I'm going to show you some examples of Israeli company RSUs or stock price and what essentially happened to that stock price over the past number of years. And we'll think about how risk relates to the actual goal that you have for the RSUs themselves. So let's start by taking a look at Monday.com. Mostly because it's the employees from that company that I've worked with the most when it comes to RSUs and very, very familiar with their stock price. And we can see here huge volatility. When Monday first went public, they were at about $200, and they went up to close to $400, and then they went down to $90, and then up back to like 320 recently, and then just over the past like a month or so, 2 months, have gone down again to like $250. And when you look at this roller coaster, and you think about the actual amount of money, not just in percentage terms, but I had $100,000 and then it went down to $50,000, those kind of things, you can see how there's a lot of risk involved here. The other thing that we have to think carefully about is that when you've got a diversified portfolio, you're never really scared of your stocks going to zero. But when you hold one company, that risk is there. And as the price goes down and down, it can cause a lot of panic and fear. And so when we're thinking about looking at risk in the context of these ups and downs, if the RSUs are going to be used for a short-term bucket, then we don't have the time horizon to be able to really handle this volatility. In other words, if you've put aside money, if you've said 100,000 shekels of my RSUs are for a car in a year and a half time, but then it suddenly drops by 40% and you don't have that money set aside anymore, then it can be a huge challenge, let alone if you're using it for everyday spending. Let's have a look at one or two more, and then we'll talk about RSUs in the context of your long-term bucket. Wix, very similar. You can see the huge meteoric rise up to also close to about $400, and then a drop to the same kind of extent that we saw with Monday, and then really increase. There's a lot of similarities here in terms of stock price, at least over the past 5 years, when it comes to Wix as well. And then you have companies like Riskified that launched at a very high price and collapsed to about $5 and haven't recovered since. And I think when we're thinking about RSUs in the context of our long-term bucket, this is something that's important to pay attention to. Because however much we can believe in the company that we work for, we have very much tunnel vision because we work in that company. And there's a lot of different factors that can affect the stock price of any particular stock. And it's important to recognize that when you're invested in one stock for the long term, there's a lot of potential risk involved there. And so one of the things that we might want to think about as we proceed is, even if you don't need the money right now and you're planning for your RSUs to be a part of your long-term bucket, perhaps you still want to be invested in stocks or still want to be invested in some way, but you might want to think about diversification and how that fits into your overall planning. So that's really just as an introduction, and starts to tackle one side of that question that is the theme of this webinar: when should I sell my RSUs? And taking into account risk, financial planning, and diversification is going to be an important component. Now we're going to jump over and look at some of the US tax issues and the Israeli tax issues, and then we'll bring it all together and open up for question time. Okay, Aryeh, feel free to.
All right. Just
take
one
over.
second. All right, do you guys see the presentation?
Yes.
All right, perfect. So let's start about taxes in general, right? So Nadav mentioned we have three major time time points on the timeline that we want to refer to. We have the grant, we have the vest, and then we have the sale. So the grant, as Nadav explained, is when we got it from the employer. And at this point, the US are very much impartial about it. They don't really care about what happened the day you got it. We will talk about tax strategies related to that a bit later. But in general, from a US tax perspective, the grant itself is a non-issue. Whereas in Israel, when we look at the grant, Israel says, I'm not going to do anything right now, but I really need you to freeze that value right now, right this second, because we will be potentially using that value down the line if you hold for a relevant amount of time, and if you sell in the future, and assuming that the value of the stock goes up and is eventually higher than that grant amount. The next period of time we have is the vesting. And the vesting itself, this is where Israel actually sits aside and he says, well, nothing happened over here. We're all good. However, the US come and say, well, you know what? This is actually an interesting time because right now you became a shareholder of this company. And that's exactly what we spoke about just before, and saying you just became an actual holder of this company, which means you have an asset in your hand which is worth something. So as far as the US is concerned, they're saying, okay, you just got a value right now. And if we said, for example, it was $200 and you got 250 stock, you have $50,000 worth of assets in your hand, which you could work on, we could work with, then this is a great time for us to tax you. Okay, so we said grant, Israel cares, US no, vest, Israel doesn't care, US yes, and then we move on to the sale itself, and here is the only time basically where the US and Israel say, well, yeah, this is definitely a tax event, but even here, there's a difference of how exactly each one of them taxes them. So let's talk about those for a second. Basically, we have two components that we care about when it comes to taxation. We have two major routes of taxation. The first one is the marginal tax rates. That's what we're taxed on when we have wages, right? So when we get a salary, if it's ours, if we have a regular salary every month, we get a pay slip. And on that pay slip, we have our maskoret brut, our gross salary that we get. We're taxed at marginal tax rates. In Israel, those tax rates go up to 47%. In the US, they go up to 37%. Each one of the states, each one, Israel and the US, have their own types of mas yesef. We're not going to get into those right now. But in general, we have the marginal tax rate, which would say, based on how much, the more you earn, the more you're going to be paying. I'm assuming everyone here is familiar with that. The other route we have is a capital gains route, where in Israel it's very, very straightforward. It's 25%, it's flat across the board. Again, not getting into mas yesef and not getting into other specific treatments, but in general, it's very, very straightforward. You see a number, you divide it by 4, that's the taxes, goodbye. The US obviously like complicating things. So here we again differentiate between two different routes. We have what's called the long-term capital gain. We have what's called a short-term capital gain. A short-term and long-term are differentiated by how long did you hold that asset before it was sold. When the breaking line is 12 months. If I held it up to 12 months, it's going to be it would be taxed as short-term capital gain, which essentially what it means is I'm going back to the marginal tax rates. I'm going to add it into your wages, and I'm going to be taxing you at up to 37%, depending on how much income you had overall. Whereas if I hold it for over 12 months, then we go into the long-term capital gain. But here, once again, the US make it interesting. So instead of, like Israel, they say, here the flat rate of 25%, here they give a marginal tax rate as well. And it's got 3 brackets. It's got a portion of it could potentially be taxed at 0%. Another portion, the next level is 15%. And then the final top long-term tax, capital gain tax is at 20%. So overall, it's lower than the 25% rate in Israel. However, as we understand, it's much, much more complex to understand where exactly am I in, and even more so, how much is that actually going to be money-wise? Okay, now if that's not enough, the US go and complicate it one step further, and they say in Israel, it doesn't matter what other income you had, as we said, it's 25% full stop. In the US, it's close to impossible to understand what the actual effective tax rate is because it doesn't look only at your capital gains in order to determine if you're going to be at the 0, 15, or 20% tax rate. They look at your overall income, and that's going to determine what your specific gain over here is going to be taxed out. Now, why does that make such a difference? Because when we talk about credits and we want to try to understand how we're going to be using or how much exactly are we taxed on this income, the fact that I'm adding the gain in to my overall income means my marginal tax rates changed once again. So that's another complexity we need to take into account. There are various ways to try and understand how much we paid. It's less of a question of how we manage it, but more to understand where we're standing. But that's the two routes, the two general routes that we have when it comes to taxing in general. When we talk about RSU specifically, here again, we have a bit of a differentiation between Israel and the US. So Israel, what it says is we froze the value when the RSUs were granted. So let's say, for example, it was $20 per share and I got 200 shares. So more accurately to say 200 units. I got 200 RSUs and each one was worth $10. So they're going to take that value and they're going to freeze it and they're going to put it aside. Next, we move on to the vest. We said in Israel, nothing happens. We move on to the sale, and I sold my RSUs, which are now already shares. I sold my shares, and I made a profit. Let's assume they went up to $25 per share. What Israel does is I said, okay, we have two components. We have the first component, which is those $10 we spoke about. That's going to be taxed at marginal tax rates. Anything else you made over that could potentially be taxed at a 25 tax rate as capital gains. However, we have a condition. The condition is we want you to hold them for over 24 months. So basically, if we did that, we looked at grant, we held it for an entire 24 months, and then we sold, and we sold for a higher amount than the grant value, then we're going to have the first portion being taxed at marginal tax rate, and then anything else over that amount, meaning in our example, the difference between the $10 at grant and the $25 at sale, those $15 are going to be taxed at a 25% tax rate. When we look at the
And
US,
Ari, maybe just on the Israel, just to drive it home, to
sure.
relate it to the numbers that I gave you previously. So I said that you're going to be taxed somewhere between like 35 and 50%. But if the stock price goes up, then you'll be taxed at a lower rate. So essentially what we're doing here, let's imagine that when at the grant, the stock price was $20 and then it stays at $20. Well, there's no gains here. And so the amount that the company gave, the value the company gave you is going to be taxed at marginal rates, and that is often around about 50%. But if there was a gain, so let's say the stock price went up from $20 to $50, then a lot of what you're selling is actually gains. And so that portion is going to be taxed at 25%. And so that's when you have a look at kind of the average rate or the calculated rate across both portions, that's when you get down to a lower tax rate of like 35 or 40%. And so that's kind of the theory behind why the tax rates will range between those two numbers.
Right. And even if you want to take it one step further, then what happens when the actual sale, the actual value starts going down from the grant? And then at this situation, it's could be taxed at 50%, but it's going to be 50% of a lower price, which again brings you to a lower effective tax rate. But in this case, unfortunately, you're also going to have less money in your bank. So that's kind of worst case scenario. There are also more variations that we're going to have to account for, and we're not going to get into each one of these. As I said, there are literally dozens of variations. But what happens when the price starts going up and then it goes down? What happens when it goes down by vest and then it goes up again by sale? And so there are a lot of things to take into account, and we could slightly touch that a bit later. When we look at the US side of things, so here again, we have a similar differentiation of the components, saying we have the marginal tax rates and we have the capital gains rates. However, as we mentioned, in the US, the taxation itself applies at vest. Okay, so we reached the vesting period, and now we've got this value of these RSUs. Right here, immediately, if you did anything or didn't, it doesn't matter. You're taxed at the value of those RSUs on your tax return. And that value is going to be the marginal tax rate. Okay, so we're going to take whatever number of shares you had vested times their value at the date of vest, and that's going to simply be added into your wages as if you got more money. Now, one of our issues is we didn't actually get money over here. So we're supposed to be paying taxes from our pocket, but we have no funds to pay for them. So that's, let's get back to that one, but that's something that we need to be aware of, which triggers a lot of issues. Now, the next component is basically going to be what happens between our vesting date and our sale date. Now, over here again, like the US love to do, as we said, things are going to get complicated. So here we're starting to count a 12 months period. If I sold between vest before the 12 months are over, I am going to be taxed at capital gains rates. However, it's going to be short-term capital gains, which essentially means we're going back to the marginal tax rates. But that's not it, unfortunately, okay? Because our issue is that the gain now is considered a passive income. Even though it's taxed at the marginal tax rates of active income, it's considered as passive income, and that's an issue. And again, we're going to pin that point. We're going to get back to it a bit later. But I think everyone's already understanding there is no straightforward explanation to how the things work. I'm going to try to make everything clear as we go on. And as Nadav said, we'll leave some room for questions towards the end. Let's continue with our example and say we held on for more than 12 months. At that situation, we're going to be taxed at capital gain tax rates, which are going to be up to 20% based on a lot of things like we said. Now, let's get back to that point of passive and active taxes, because that becomes a significant portion of your planning moving forward. I'm going to back up and I'm going to talk about, we spoke about marginal and we spoke about the capital gains. However, when we talk about the interactions between Israel and the US, basically, this is very high level, but it's rule of thumb, it usually works. Israel's going to be getting the first bite on your taxation. And that doesn't matter if we're talking about the wages or if we're talking about capital gains. Israel gets first bite in both cases. And that's important. And I'm just going to say as a side point, that's not the case for dividends and interest when it's a US company. And that is something that you need to be aware of. But we're talking about right now wages and capital gains. And what happens is you need to first be taxed in Israel, take those taxes as a credit, and then you could come to the US and say, by the way, I have this income now, however, I already paid taxes, so don't tax me twice. The way the interaction between the countries works based on the treaty is something that's called a buckets system. So we have a few different types of buckets. The two major ones that we're interested in are what's called a general bucket. That's where all the wages and self-employed income go into. And then we have a bucket called a passive bucket. And that's where all the income we generated not from work would go into that bucket. And the rule is, and this is super important, is you cannot use credits from one bucket for taxes that are under income from another bucket. Okay? And when we're talking about that term of less than 12 months and we are being taxed at short-term capital gains, but paying at marginal tax rates, I'm not allowed to use the taxes that were paid in Israel for the marginal portion, for their wages income, against this portion of the capital gains in the US. Okay, so that's one point we need to be aware of. The second thing is, we spoke about the fact that at vesting, we have a triggering event in the US. We don't have one in Israel. We have to pay taxes in the US, but we haven't paid a dime in Israel because nothing happened in Israel. Now, the issue is that if I came to the US now and I paid them taxes for my vested RSUs, and later on, not the same year, I sold those shares for a profit and I paid Israel. I need to pay Israel for the margin for the portion of the marginal wages component of the RSUs. I can't come to Israel and say, by the way, I already paid the US. That's not an option because Israel is entitled to first bite. And then we have an actual situation of double taxation. And the treaty tries to do its best in order to not have double taxation. It's not the subject of this specific webinar, but in general, we usually don't pay twice. We report twice, but we credit for one another. But this is one of those unique situations where, albeit the treaty being relevant, it's not able to protect us from the double taxation. And what happens is essentially is we pay the US first, and then time goes by, we make the sale, Israel says, now it's my turn, and we need to pay Israel once again, and we have an actual double taxation. So that is key, and probably the thing you're going to hear most when it comes to planning as dual citizens and RSUs. So we explained how Israel works, we explained how the US works, and we explained how the interplay between the two of them works. And bottom line, yeah, you definitely need to care about the timing and when you decide to sell or not sell your RSUs, and how do we do things in order to plan and make sure that we're not paying twice. Now, when we try to think about solutions, we have to be creative, okay? There are a variety of options that we could try to use in order to mitigate, and we're going to run through the basics and most common ones, but this is definitely something that you have to think out of the box, mostly because we're taking into account so many variations. We don't know what the risk factor is, and if the prices are going to go up and down, up or down in the future. We don't know what the tax rates are going to be in the future. If I, for example, decided to hold on to my RSUs, to my vested shares, and stay with them until I retire to pension or go for early retirement, that means that in Israel, I might have a flat tax rate, but that's going to drastically change how much taxes I owe in the US. Because if I don't have any other income, it's very possible I'm going to pay only 20% in general for those gains. So there are a lot of things that we want to take into account, but let's focus on the major ones and the ones that are most common. So the biggest thing that we do is we use the foreign tax credits at the vesting period itself, right? So we were granted with shares, with RSUs, time lapsed, vesting period was over, and now I didn't sell my shares, and I don't have an event in Israel, but I do have a taxing event in the US. And I didn't pay any taxes, but somehow I don't want to pay the US because, as we said, I won't be able to later credit them in Israel. So at this point, the vesting itself is considered an income event that's going to be under the general category of tax credits because it's taxed as your wages and it's taxed at marginal tax rates. When we look at the taxation rates in Israel and the US, like we described earlier, those in Israel are much higher than those in the US. In the US, we go up to 37%, whereas in Israel, we go up to 47%. And we have a rule called the carryover of foreign tax credits, which essentially says we could take credits that were paid in Israel, taxes that were paid in Israel, register them on our US tax return, and if we didn't use all of them in a given year, we have 10 years to move forward with them before we lose the ability to use them. Okay? So if I took my income every year, and let's say I'm taxed at the highest tax brackets, both in Israel and the US, every year I'm putting aside a 10% difference that is not being used in Israel and that I could use in the future in the US. Now, let's say I had a vesting event in 2025. I didn't sell. And now when I calculate, when I prepare my US tax return, my income is going to be comprised of both my overall gross wages, my brutto, but on top of that, I'm going to add in the value of my invested shares. And when I add those in, I'm going to say, this is going into my bucket of general income. And therefore, I'm going to use also the additional 10% that I had this year paid in Israel. but also all those 10% from the past 10 years that I haven't used. In a lot of situations, that's sufficient enough to cover all our taxes, and that's going to be the end of it. The next option we have is to do a same-day sale. As we said, the only one place where Israel and the US agree upon is when we sold the shares. Now, everything becomes more simple from a tax perspective when we do same-day sale, for the simple reason that we're putting everything in one place. So we have only one component. It's going to be in the US. It's going to be all wages. We don't have a capital gain component. In Israel, if you held for less than 24 months, then you're subject to marginal tax rate. And again, it's considered as wages. And I pay taxes in Israel, and I could use those taxes in the US, and that's the end of it. All right. So I basically just have on both my Israeli 106 and on my US tax return the same number of income, the same amount for the income, the same credits, taxes paid in Israel are going to be higher than those in the US, and game over. It obviously makes life much, much simpler from a tax perspective and specifically for dual citizens, but there are, like we know, so many other factors to take into account, which doesn't make this always the best option. You're losing out on, you're basically coming in saying, I'm willing to voluntarily pay 50% now on the entire value and not go down to the effective tax rate that was mentioning of 35 or 40%, which can become very, very significant over time if you have a large amount of RSUs and the company's successful, and you're losing out on that benefit. So that's one consideration to make, but it's not the only consideration, and therefore it's not always going to be the right option. Another option is to do a blend. So what we're going to do is we're going to try to understand how much taxes I'm going to owe in the US after I took into account all my foreign tax credits and all the carryovers of my foreign tax credits, and see how much more will I need to owe the US, and basically artificially generate a sale of a portion of my RSUs, pay Israeli taxes just for that portion, use those as a credit in the US, and that way I'm able to not pay double in the US, as well as have sufficient funds in my pocket right now to pay the US, to pay taxes. So I'm not actually paying them in the US, but I know I'm avoiding the double taxation, and I know that I have a stream of income to currently pay the taxes. A key factor to take into account when we do look at this kind of option is that the sale in the year of vest doesn't specifically have to be from those shares that vested. So if I have grants that I received over various periods of time with different grant values to them, I could choose to sell specifically whatever batches of RSUs that are received that are going to be most beneficial, remembering that when Israel come and try to understand how much taxes I'm going to owe now upon sale and what's going to be added to my marginal tax rates, it's going to take the grant value. Okay, so I could have 100 shares of my third batch vest today in 2025, but sell shares for my first batch, have them cover the taxes I'm going to be owing, not touching at all my third batch, and still be in a better place from a combined US and Israel tax perspective. One more option, and there are more options, and I could go on for hours. I think we're mostly trying to explain that things should be considered. But one more thing that I am going to say is, and this is talking creative again, and this is not for everyone. You have to have risk tolerance from a tax audit perspective. There is a differentiation in the US between taxes that were actually paid and taxes that we know for sure are going to be paid, and for how much that number is. Okay, the rule in the US to pick up foreign taxes isn't necessarily that they were actually paid. The rule is they have to be certain and they have to be determinable. So if I'm able to reach a situation where I know for a fact that I'm going to pay X amount of money, even if it wasn't paid, that can theoretically be an accrued foreign tax credit that I could use in the US. Now, when we try to take that into account when we're talking about situations like ours. When I am granted with shares of a company while living in Israel, Israel says we're freezing this amount right now, and this is going to be taxed at your marginal tax rates. So with a very high degree of certainty, unless something unusual happens, I know I'm going to be paying marginal tax rates, and I know what the value is today. And so there is place to take a position saying, I'm not going to pay a dime in Israel, but I am going to accrue the taxes I know I'm going to pay in the future. I'm going to carry them over with me until the vest date, and then I'm going to use them against the US taxes I need to pay upon vest, even if I didn't sell one share of my portfolio whatsoever. So again, IRS are not necessarily going to agree with that. Potentially, yes, it's completely legal, not a doubt. There are questions of what happens if all of a sudden the stock crashed and then that value you are certain about changed. So there's different treatments we have to do, and that's why I'm saying this isn't necessarily relevant for everyone, and it would definitely try using the other approaches we discussed before going to this one. But we have seen situations where this specific approach has saved a lot of money for our clients. One more thing I didn't touch, and I intentionally didn't touch it, and that's why I'm just going to mention it, is the exclusion of foreign earned income. Okay, just in a nutshell, exclusion of foreign earned income is up to a certain amount of income that you make every year. If you didn't visit the US for over a certain amount of days and you can show your center of life is here in Israel, you're allowed to exclude foreign earned income from your US taxes on your US tax returns form 2555. And what it says is, for example, if I made $100,000, so I list that I earned $100,000 of wages, and then I could exclude that amount, and that the exclusion amount changes from year to year. In 2024, it was $126,500. And that means that up to that amount, if I had earned income, I can exclude it. So if, for example, my overall income from gross salary was $100,000, and then I had $15,000 or $20,000 of vested shares, I could exclude them. I'm going to add them into my exclusion, and therefore I don't have to pay dime taxes in Israel, and I won't owe the US anything. It's because the limit is relatively lower, it's not something that always comes into effect, but that's definitely something that could also be relevant if you're at the beginning of your career at one of these high-tech companies, not yet making those big bucks, and it's definitely something that could also be helpful.
So Aryeh, if there's all these different options that are on the table. Let's say, there are people here, they have a certain amount of RSUs, they're also US citizens, and they've got all this complexity to deal with. What would you advise them to do?
So the major question is, what do I have to lose? And based on that, I would decide how much I have to earn, right? If I took someone, and I see this a lot, clients who have RSUs, but for example, like we just mentioned, entry level, the RSUs are worth $2,000 or even $10,000. Most likely, it's not going to trigger too much of an issue, and the planning and analysis of doing what could I do over here would be costly, right? So I wouldn't run the second I got RSU and say, hey, should I pay hundreds of shekels now to get consultation to understand if I'm in an issue or not? And I think the key factor we look for is, have you been in a position that you pay taxes in the US before because you weren't properly prepared for it, and obviously taking into account that no material difference happened. So if you never paid taxes before, but this year all of a sudden the company's IPOing, or this year all of a sudden you got a huge raise or a bonus of RSUs that are about to vest, that is something I would consider. But for a lot of the population, it's something to be aware of, but not something to be afraid of. When we're talking about the people who have a more complex situation, nice earnings, the recommendation is reach out. And the timing of reaching out is so important here, because the biggest issue is you can't retroactively mend things. Okay, when people come to me today in July of 2025 or August of 2025 and say, okay, so I had RSUs that vested in 2024, I didn't sell them, let's prepare my 2024 tax return. And I come to them and say, okay, great, you have $22,000 of tax due. Oh, what should I do? there's nothing you can do. It's too late, right? Planning has to happen in advance. It can't happen after the fact. So yeah, we're going to play around with the various things we spoke about and try to bring the credits from here, credits from here, and stuff like that. But you have to prepare in advance. If you know you're a high earner, if you know you're getting a nice amount of RSUs vesting during 2025,
Can you give a bit of context? Like, what's a high earner? Like, where would you roughly put obviously there's no exact number, but just to
right. So the easiest number to work with is that exclusion what we just mentioned. In 2024, it was 126,500. In 2025, if I'm not mistaken, went up to $130,000. If you're making lower than that, including the vested RSUs, most likely you're not going to have an issue. Okay. If you're making over 40, 50,000 shekel a month and you've got RSUs and the RSUs are a substantial amount, that's the time to reach out. And we know the market today. We know a lot of our clients are making very nice amounts of money. We don't even have to name the companies, they're all here. And it's common. It's not something that's only relevant for those people that we don't know and want to be like. It's something that we actually meet on an ongoing basis. And maybe just to add into that, we mentioned the 126,500. However, if you, for example, have children or US citizens, you're not going to do exclusion of earned income. And therefore, that becomes not relevant because if you take the exclusion, you can't get the child tax credits, which are refundable. So wait, that not necessarily good enough. If, for example, you visit the US a lot, if you still have family there, if you travel for work, and you're in the US for over 35 days during the year, you're not entitled to take the exclusion for unearned credit. And again, that changes. So everything we're talking about here is, rule of thumb, try to give milestones or benchmarks, but they're not set in stone, and every situation is individual.
And if there are people here, and this is what I'm going to talk about in a moment, if there are people here that are regularly selling their RSUs, they're selling a good portion of them every year, in order to not build up any too largely significant amount in the company that they're working in, then would you assume that in most of those cases they don't have to worry about excess US tax at vesting? In other words, they should have enough tax credits, Israeli tax credits.
So it really depends on how much you're selling, but yeah, if we're assuming these are people who are selling nice amounts, and nice amounts, it really depends. It could be over 50%, less than 50%, it could be 10%, but you're getting a huge amount of RSUs and so on. But if you're selling a significant amount that's triggering additional Israeli taxes, very, very likely that's going to cover your issues. And obviously, as we said before, anyone who does same-day sale, those are completely not an issue to start with. And that's, best case scenario, again, from a tax perspective.
Yeah. So if we summarize cases where you shouldn't have to worry too much, number one, if you've been reporting the vesting of your RSUs to your US accountant and you haven't generally had to pay US tax, then unless there are major changes, you should be relatively safe. If overall your income, your job income, plus the vested RSUs of that year are under about 100 and something thousand dollars, then in most cases you won't expect to have excess US tax to pay. And number three, if you don't have like a really significant amount of RSUs, if you just have a $10,000, maybe a bit more than that, then in most cases you shouldn't have too much of an issue. And if you're selling, I don't know if I said this one, but if you're selling regularly, and you're selling significant amounts regularly, then you probably also don't have a significant issue. But if you don't fall into those categories, and you've never sat down with your US accountant and actually done a consult and an analysis, then that would probably be highly recommended to do.
Absolutely. And I'm just going to add in one more factor. A lot of times, in these companies, we see that you're allowed to sell at certain times. It's usually, given their public, it's not an issue to sell, but there are sometimes constraints related to the grant agreement itself, saying you're allowed to sell in certain windows throughout the year, or they give opportunities to sell even though they weren't fully vested and stuff like that. We've seen that before in Sentinel One. I've had it with clients in other companies, and those take you to a situation where your planning has very, very specific timing that it's relevant. It's not only, until the end of the year, until December 31st. Rather, if I know I have a window only in October, and once that window's closed, I won't be able to sell certain portions of my shares. Well, you got to do your planning in advance, because starting to do the planning only after, only during that window. Oh, wait, I have a window now. Let me run and try to check. The planning isn't something that takes a minute and a half. It has collecting of information, analyzing the information, understanding market trends, and so on to come to decision. And it's not something that's going to be over within a 2-3 hour session.
Yeah. Okay, cool. Great. So I'm going to...
Sorry, that was just one more small point that's related but not related to everything we spoke about. We have something that's called net investment income tax in the US. It's similar in the idea to Mas Yasef in Israel. It's very, very different in execution. All right. So what it says is, if you're earning over a certain amount of money and you have passive income, your passive income are going to be taxed at an excess tax rate of 3.8% on top of any taxes you already paid, regardless, for your earnings. Now, this taxation is a tax that goes to the social, it's of a social security nature, which means right now, and this is pending a few different court cases, but right now, you're not allowed to take foreign tax credits against that. So this would only apply to income that's considered as passive. And sometimes when we decide not to do same-day sale, and we say, okay, so I'm going to do a long-term capital gain, I'm going to have my 25% taxes in Israel, and then I'm going to have my 20% taxes in the US, and I'm going to be covered, you will potentially be hit with another 3.8% on those taxes. So two things to take into account is, number one, if you're not over the threshold, you may want to sell a portion of your RSUs to not be subject to that additional 3.8%. And number two is, take into account, even if you did pay 25% in Israel, you're potentially going to pay another 3.8% to the US for this additional tax.
Okay. Okay, good. So, I mean, as you can all see, it's not simple. This is one of the more complex areas of US Israeli taxation interplay. And if you fall into one of those buckets where you potentially have a lot of RSUs that have built up over the years that you haven't sold, maybe haven't been reported to your US accountant at all, then we'd highly recommend to sit down with not just any US accountant, but someone that really understands RSUs to do this kind of consultation. And Aryeh, maybe just if you want to say like one or two words about kind of SimpleTax from this perspective. So, I mean, you've got the platform online and people do their reporting. If someone comes to you and wants to analyze their RSUs, then they would pay you for a consultation. Is that how it would work?
Basically, yes. What we do is we take the 2024 tax return or the last year tax return. We do an update of what the expectation changes, what the expected changes in your salary. For example, a 7% or 10% increase in salary, and my investments are going to look like ABC. And then I have the following grants during the year, or had the following vests during the year. Take all of that into account. We do a mock tax return to see what your 2025 result is going to be looking like. And then based on that, we could tell you, okay, you're good, or you should sell a portion, or even what portion you should be selling. And basically, it divides into two. The first part of it is a straight, simple consultation. It's going to be usually a call with me or another tax expert we have in the company, and just to explain how exactly everything works, tailored to your specific situation. So I won't be talking 40 minutes like I just did. I'm going to be looking at your situation and explaining how exactly you're affected by that. The second option is a more deep dive in analysis to your situation, to your status, and based on that, coming also back with recommendations.
Okay, cool. Great. So I'm going to dive back in, share screen again. Excellent. Cool. So what I want to try to do is tie everything in where possible and give a bit of a path forward, where we think about diversification, we think about the Israeli tax, and we think about the US tax issues. So if we take a step back and we just think before we spend that time on tax, that what I was speaking about before, there's a lot of risk in holding a lot of your money in RSUs in your own company. And here I'm talking about, the average Israeli high-tech employee, you're earning money, you're building up some wealth in RSUs, perhaps you're investing otherwise, you're building up your savings, and you'd like to use this for various goals, various family goals now and into the future. And diversification is important. And so if I have a lot of clients that come to me and ask the question, like, I'd like to diversify. I probably want to sell quite a bit of my RSUs, but should I sell everything right now? Or should I consider like splitting that sale over more than 1 year? And so here, what I want to do is touch on some of the Israeli tax issues that are involved, and then get to a conclusion, which we'll see what Aryeh thinks about and whether it deals sufficiently with some of the US tax issues. So there are a few different factors to take into account. Three factors. Number one, 2 years from grant. So we saw before in the timeline that when we take the grant date, here we don't care about the vest dates from an Israeli tax perspective. We take that initial grant date. If we wait 2 years until we sell anything from that grant, then the portion of the growth, anything that has grown beyond what the price was back then we'll pay only like 25% instead of potentially about 50%. And so that is an important factor. And if the price has been going, if the price is just stagnant, then this doesn't really affect us too much because there's no growth portion. But if the price has been going up, then we'll do quite a lot. This will be like one of the top priorities to consider waiting those 2 years rather than give up what can sometimes be a quarter of all your holdings in tax, right? The difference between like 25% and 50%. So that one there is one of the most important factors when we're trying to calculate and time out the sales of our RSUs from an Israeli tax perspective. The second factor is what was mentioned a few times, this concept of mas yesef. It's like this wealth tax. Essentially what it is, there are now two different types of mas yesef. If in Israel your total income, and that's from wages and from capital gains from all different sources, is more than 720,000 shekels in a particular calendar year, then anything that you earn beyond that, whether it's wages or capital gains or RSU sales, whatever it is going to be taxed an extra 3%. And if you happen to have capital gains, specifically from sales of stocks in your stock portfolio, or from sales of the growth portion in the RSUs, if you wait the 2 years, if all your capital gains specifically are over 720,000 shekel, then you have to pay another 2% in this mas yesef. And so I want to show you an example so we can have a look to see whether when we're balancing risk against this particular tax, whether it might make sense to sell right now if you're looking to diversify, or to potentially spread out that sale. So let's have a look at this example. We'll take someone they earn 25,000 shekels. And so their annual income is around about 300,000 shekels. And let's say they've got 700,000 shekels of RSUs and they want to sell them. Maybe let's take a very typical situation that I've come across a lot. They want to buy a property using this money in 12 or 24 months from now. And so, you might be worried that the stock could have a crash and you really want to get out of that sooner rather than later. And you're considering selling 700,000 shekels. And you're wondering, should I sell it all this year or should I maybe split it up? Sell some this year and sell some in 4 months' time, 5 months' time when we go into 2026. So if you sell all of it in this year, then you'll have 280,000 shekels, which goes above this mas yesef limit because you've got 300,000 from your income, you've got 700,000 from the sale of the RSUs, you've got 1,000,000 shekels altogether, and so you've passed that limit. And so it would be subject to an extra 3%. And so that would be an extra 8,000 shekels of tax. If you waited, then you would save those 8,000 shekels of tax. But what you have to think about is whether that might make sense to you from a risk perspective. If you take 8,000 as a portion of the 280,000 that you would potentially wait, as a percentage, it's pretty small. I think that's about 2 or 3%. And you'd want to think about what's the chance that the stock might drop by 2 or 3%? Of course, it can go up. With risk, we're talking about both directions, but we're worried about the reductions. And so what we find is that in many cases, in terms of tax planning in Israel, the Mas Yesef differences are often relatively minimal compared to the risk that might be involved in waiting. So that's factor number 2. We spoke about waiting 2 years, which is quite important. We looked here at Mas Yesef and how much that should come into play with the planning. We saw that in many cases, not all, but in many cases, it isn't the most important factor. And the third factor is your tax bracket. Whether it is possible to do a sale in a particular year in which you might fall into a lower tax bracket and therefore pay less tax. And just because we don't have a lot of time, I'm not going to go too much in depth here. But firstly, I want to show you where the jump in taxes actually happens. So Aryeh mentioned before that for most people that are earning well in high tech that have RSUs, in any case, just from your wages, you'll probably be paying 43 or 47%. There's not much difference between those two. Anyone that's earning, you can see here that once you pass 16,000 shekels a month, then you jump up into this tax bracket of about 43% when you take into account your bituach leumi. And so if that's your wage, above those kind of numbers, and if that's how much you're earning throughout the year, then it's going to make minimal difference in trying to split out your sale of any amount of RSUs above that across, more than one calendar year. Where it really does potentially come into play is if you're anticipating, let's say you're anticipating in 2026 to work not very much. Maybe you're going on an extended maternity leave, or maybe you're taking a sabbatical or an extended, what we might recall like mini retirement, or retiring often, which is a concept which I've written about before. So in a case like that, let's have a look at that example. Right, back to the same situation. You earn 25,000 shekels, so 300,000 shekels for the year, and you have 700,000 shekels of RSUs that you want to sell because you want to buy a property soon. If you sell all of it this year, then in terms of your tax brackets, on the portion in which you'll pay your marginal tax rates, which let's say is up to the value of when you originally received the RSUs, the value of the grant, you'll pay 47% income tax plus bituach leumi. But in 2026, you're only planning to work for 4 months of the year, so that's 25,000 times 4. You're only planning to have about 100,000 shekels of income for that year. So let's take a look at 100,000. If you only have 100,000 shekels of income for that year, then on the first portion of RSUs that you sell, in terms of marginal rates, you'll only pay 26%. And then there'll be a portion where you only pay 32%, and there'll be a portion where you pay 43%. And so I did the math on that, and it turns out that in a situation like that, you'd save 18,000 shekels from just because you fall into lower tax brackets. And so then you'll have a look here. I save 18,000 because of my lower tax brackets. I'll save 8,000, which we looked at before because of my Mas Yesef. Already maybe there's something to talk about here. And then you can think about the potential risk versus the known savings in tax. But you can see that it has to be quite an extreme situation where you're going to have a year with very minimal income to really make much of a difference at all when we're comparing to the potential volatility of the price of the RSUs themselves. And so because of that, when we take all of this together, there are a number of conclusions that at least I reach in most cases when I'm working with clients. So number one, I think one of the first factors that you should take into account, if you fall into those buckets that we spoke about previously, where there is a significant risk that you might actually have US tax owing, then it is worth taking into account those considerations and potentially selling a portion of your RSUs and the correct portion in order to generate enough Israeli tax credits to not have to pay tax in the US. That's probably one of the first considerations to take into account if you have a significant number of RSUs that are vesting. And coming back to everything that Aryeh mentioned, you should do a consult. Number two, when we're having a look at the RSUs that maybe were only granted a year ago, if the price of the stock hasn't gone up, then we don't have to worry too much about the 2-year wait because there's no gains and it won't really affect us. But if the current value is above the grant price, then generally on that RSU portion, it is worth waiting 2 years before selling that portion. Again, putting aside US tax considerations, we've already dealt with those. So that's usually kind of the second principle that I take into account. Once we've looked at both of those and we're really looking at the grants that I received more than 2 years ago, then we want to start seriously considering selling stock that we selling RSUs, or now stock that has vested and that we own. Because if we want to use it in the short term, then we don't want to risk going through a major crash of this very volatile asset. If we want to use it in the long term, then we can seriously consider opening up our own brokerage account or other kind of investment and investing in something that's a little bit more diversified. It allows us to diversify the risk. It also allows us to not get into this situation where you've suddenly got 700,000 shekel of RSUs to sell in 1 year, and you have to start worrying about high tax brackets and mas yesef. By selling regularly, you can avoid those things as well. And if in particular you are planning a year with very low income, then maybe there's some more complex tax planning to do from an Israeli tax perspective. But otherwise, I think these principles will really serve well most people in most scenarios. And I guess it's important to come back to what we started with, that this is really general guidance, general education. And Aryeh can attest to, as much as more so probably than myself, there are always edge cases. And sometimes this kind of guidance doesn't apply to everybody in every situation. I'll finish off just by giving a little bit of a tip on ESPP for those of you, because you work for public companies. Many of you are going to have an ESPP package, which is essentially where you can choose to deduct some of your salary, buy stock of the company, and then potentially sell it immediately. From an Israeli perspective, and my understanding is if you take this kind of position, and Aryeh, it'd be great if you can jump in after this as well, it shouldn't affect US taxes too much. There is a significant advantage in signing up for the ESPP plan at the maximum level possible and then doing quick sell, because that essentially gives you a guaranteed return with essentially zero risk. I won't get into the details of it, but if you do have an ESPP plan at work and you haven't signed up for it, then certainly learn more about it. And you can also reach out to me if you like to learn more about kind of how it works and what the ins and outs are of the tax calculations here. Aryeh, would you like, if someone signs up to ESPP, does quick sell, are there any US tax issues to worry about?
None whatsoever. It's amazing. It really is one of those very, very, unique situations where, again, specifically if you went for the quick sale, it's not just assigning for the SPP. If you went for the quick sale, we're following case on Israel over here, no additional issues in the US, and that's it's a win-win.
Okay, excellent. Good. So firstly, we recently went over time. I have time to stay for questions. So let's open up. I'm going to stop the share so we can see everybody.
Maybe just one more thing for me, Nadav, if it's okay
yes.
with you. Not necessarily related to this specifically, and I think just for any US people still online, if you haven't filed your US tax return for 2024 yet, and again, this is not specifically related to the RSUs, we have until September 15th to finalize all the filings. So if you think you have time until September to go ahead with that, don't. If your accountant is SimpleTax, or if it's anyone else, you should move as soon as possible in order to finalize your tax return. And I will say, if by chance there's anyone over here who has citizenship and hasn't filed in a while, so we do have a very, very unique situation right now that's been running since October 7 with two very generous and out of the ordinary extensions that were provided specifically to people living in Israel by the US government. They're called notices 2023 over 71 and 2024 over 72. Basically, they say anything that happened from October 7th until 2023 until September 30th, 2025 is a time capsule that froze. Any tax due is not due until September 30. Any deadlines for filing are not due until September 30, which means that you could do filing that in any other year would be considered late and potentially bring penalties, and not have them considered late, you could get refunds for past years all the way back to 2020, which would be long gone and still be able to apply for them. That includes COVID grants if you haven't received them. And in general, that's a very unique situation, and advantage should be taken of it if you're not up to date with all your filings.
Okay, great. So let's have a look first through some of the questions that were asked in the chat. Maybe take a look, Aryeh. I'm going to take one of them, but there's a few US ones if you want to choose one or two. But then let's open it up so we can get some questions live. There's one here that got a few thumbs ups, plus ups. Any strategies if you have a non-American spouse? In other words, there's an American who is receiving RSUs, they're married to a non-American spouse. I'm not familiar with any strategies that can help from a US tax perspective, but yeah, Aryeh, is there
The only thing that could be relevant is an indirect strategy of putting any investments that are not US under the non-US spouses, which means you as a US person, your overall income is going to be lower, which means all your tax brackets are going to be influenced by the fact that you now have a lower general income, which leaves a bit more room for you to pay lower taxes on your RSUs. But there is no option of you to specifically move your RSUs to your non-US spouse. The other thing is use the fact that you have what we call the built-in tax shelter, and do quick sales on your RSUs, get rid of them, let your non-US spouse invest in non-US investments, and completely get rid of the tax burden in the US. That is the biggest outing from this entire thing.
Yep. And as we, the guidance that we often give when we've got a mixed couple, US and non-US, and it comes to your other investments, is that there are a number of advantages of potentially investing under the non-US spouse's name. And certainly something to account for when you're deciding kind of how to structure.
And maybe just on that, I saw someone asked about married filing jointly, and if there's any advantages or if that makes any difference. It does make a difference. It makes a difference because your standard deduction is much, much higher. Without getting into that, if anyone wants to reach out afterwards, I'm going to explain in more depth. But in general, the standard deduction applies to the couple as a couple, which means you're going to have approximately $13,000 more that could be used as non-taxable income from your overall income, even if your spouse isn't making any money or is making a relatively low income. So if you're both American and you're filing jointly, then you're going to have a higher standard deduction that's going to be available. And that also is relevant if you're married to a non-US person, but you have children. And then you could be filing as a head of household. Also, if your children aren't US, okay? If you have a child and you're married to a non-US person, you could file as head of household. That's going to increase your standard deduction by approximately $6,000 to $7,000 a year. And again, that's going to give you more room to cover portions of your income.
Were there any others you wanted to grab there, or should we take some questions? If anyone wants to ask while we're taking a look, please feel free to unmute yourself and shoot a question through.
All right, I'm going to say there's a question here. If you're moving back to the US, from a US perspective, in general, you're taxed on your worldwide income regardless of where you lived and regardless of where you generated the income. So the mere move to the US is not what makes a difference. It could make a difference in terms of linearity and what is subject to tax in Israel and what's subject to tax in the US. I'm saying that we'll see huge, huge question mark on it. You're taking into account now state taxes that would apply, and it's completely new ball game. We'd have to have more than double the time just for this specific standalone. So it is something that should be considered, and that could be a great consultation subject.
Yeah, I think I'd say anybody that's moving countries, and I've seen so many situations like this and heard stories, anyone that has employee equity and is relocating, make sure you do a consult with US and Israeli accountants.
Yes, and then I think there was one that asked about the foreign earned income. Yes, it does not include dividends. It does not include interest. It includes your wages. It includes the specific portion of your RSUs that are subject to the marginal tax rate. It does not include other portions of passive income, including the increase in value of your RSUs after the portion of wages.
All right, let's take some questions. Right.
Once you sell your RSUs, can you bring that money to back to America, or does it have to stay in Israel? Does that also affect taxes where the money's going?
No, it doesn't affect where it's done, where it's doing. It doesn't matter if it's in Israel or in the US. That's a technical aspect. And because both Israel on residency basis and the US on citizenship basis tax you on a worldwide income, it doesn't make a difference where your money is sitting, and you could transfer between you. You're going to have potential compliance or bank related issues in transferring from one country to another, but that's a completely different issue. The one thing I would say about should I invest in an Israeli broker or a US broker is there are other issues that we didn't cover at all that are not related to RSU specifically, rather to PFIX and what types of investments you're allowed to do or not allowed to do. You can make PFIC investments in the US or non-PFIC investments outside the US, but as a general start point, a US broker won't invest your money in PFICs, and therefore you won't find yourself all of a sudden in an issue. So if you're a US person and you make your investment through a US broker, the chances of you being subject to harsh tax implications that you aren't aware of become much lower.
Thank you.
Any more questions from the audience? Tuvia. Or maybe you were just unmuting yourself for another reason.
All right.
Maybe his microphone has an issue.
I'm going to take this opportunity to thank Nadav for making this happen and for his vast knowledge. It's always great to tie the tax matters into real life aspects of investments and how to manage it, and not just come to it as a technical issue because the year is over and I have to do filing. I think the financial education portion of it is tremendous, and thank you for having me.
And thanks to Aryeh for joining. Everyone will see here that we shared a link here that has like a discount for SimpleTax. We don't get any kickbacks. On principle, we never get kickbacks from any services that we recommend. But we often recommend SimpleTax to our clients just because of the high level of quality work that they do, and the deep level to which they think about these issues, even though it's a service that is, the cheapest one that is on the market, and one of the simplest ones to use. So we're certainly big fans. I will answer one more question, then maybe we'll sign off. There was a question, why doesn't the ESPP have a disadvantage in Israel? Wouldn't we be taxed at marginal income percentages instead of 25% for capital gains? So when it comes to ESPP, when you sell it immediately, so firstly, when you sell it immediately, there are two components on which we have to have a look at. There's the component that you deducted from your salary, and that's already been taxed back in your salary. And so you're never going to be taxed on that again. We don't have to worry about that component. And that's most of the money that you'll receive when you actually do the quick sell. Then there is the benefit, like the discount that you got, the 15% or higher discount. And regardless of whether you sell now or whether you're going to sell in 2 years' time, that will always be taxed at marginal tax rates. And so essentially what you're doing is you're selling right now, you're paying that marginal tax, which you'll have to pay in any case in the future. And then you can take that money and move it across to your investment account. And when you eventually sell in your investment account, you'll pay capital gains on any future growth. If you don't do that, if you don't do the quick sell, and essentially you hold the ESPP for 2 years, then it is true that all the gains beyond that initial benefit, you'll only pay capital gains tax, but you could have got that immediately in your own private brokerage account, and not have had to wait the 2 years. So essentially, I don't see any benefit in not doing quick sell. The other thing is that if you do SPP and you continue to build up the amount of stocks that you're holding in RSUs and SPP, then you're just increasing your exposure to the company. And that's not really something that we want to do with the money that you've chosen to salary sacrifice. It really reduces your diversification.
So one last question. Does it matter if you work at the company anymore or if you left the company, or that's regardless, RSUs are, it's the same taxation no matter what?
So it's the same taxation. There are contractual issues that you're not necessarily going to have the option to sell them after a certain amount of time, or vesting itself won't happen because you left too soon and so on. From a tax perspective, insofar that you divested, you got the shares and you held on to them, it no longer matters if you work for the company or not.
All right. Thanks everybody for joining.
Yes.
Be in touch with either of us if you have any questions. You can contact both of us through our websites. Yeah, it's been a
Thank you.
pleasure.
Have a good night, everyone.